if software is really hated, it's really sold off, there's a potential that that means that most people have sold software. And when you have like no marginal seller, that's usually when sell pressure stops. And even if there's no buy pressure, it's not as big of a factor because all of a sudden, all you need is the selling to stop. And that's how, stocks can go sideways and eventually recover and bottom.
One, two, three, four.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 21st episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. Today, I'm joined by my co-host, Ryan. Welcome, Ryan.
Always fun to be here.
For sure. So it's been an eventful, few weeks in the markets. I mean, obviously, anyone who's been watching the market has been seeing software kind of get killed off and things like that, and some other sectors rotate. So it's been a fun or just an interesting few weeks, I guess.
Depends on what you own, I guess.
Yeah, depends what you own. So yeah, why don't you take us through kind of the market pulse, what's moving the tape?
Sure. Yeah. So favorite time of the year happens 4 times a year, which is earnings season. And I think last time we taped this, we were maybe like right just at the very cusp of earnings season. 1 or 2 companies maybe had reported. This is the first. We're really kind of in the middle of it on the U.S. side. Canadian earnings are still kind of getting started, but there's a bit to talk about there as well. So got to start with the hyperscalers. So your Microsoft, Meta, Amazon, Google, and honestly, all these reports looked, regardless of what the share prices did, the reports looked fine. They continue to generate stellar amounts of cash flow, revenues, and earnings across the board. So not really like much in the way of surprises from these companies, but there were a few common threads, I think, to pull on in these results. And one is that they're all investing heavily in their capital expenditures still. Yeah. So, and I think maybe if you wanted to point out a surprise, it'd be that a lot of these companies actually probably increased their CapEx guidance higher than maybe markets were expecting. But yeah, certainly still investing in the AI trade right now. It's them. If you own the hyperscalers in the short term, that higher CapEx maybe you may or may not like. But if you're a company that's servicing kind of that AI build out and things, you're probably pretty happy about that news. The other thread to pull on was I think just you're starting to see kind of companies get rewarded if they can show returns on the AI investment. And the key company that was doing that was Meta. They showed that they were getting kind of a lot more efficiencies from their ad business on their AI tools, higher conversions, and that actually led to a bit of a revenue growth and stronger cash flows as well. And in the earnings, after their earnings release there, the company got rewarded because of it. Whereas Microsoft was, I mean, again, their quarter was fine, but there was maybe a bit more of a touch and go in terms of the returns they're seeing on their AI investment. I think it's going to come in time. I don't think it's anything to be concerned about, but Microsoft was a bit of a laggard in terms of their recent release compared to, say, a Meta. So you're starting to see markets look past the CapEx story and more into the returns on the spending type of story, returns on the capital that they're employing. So, which is nice to see that if companies can get this to work, and we think they will, but if they can get it to work, markets will reward them as well.
Yeah, for sure. Yeah. It's interesting. That's a theme that we've been kind of waiting on for like a few years now, right? Like at first it was, okay, we know that they're going to spend heavily into CapEx and building out the infrastructure of AI, but like, when are the returns on that investment going to come? Yeah. And now it seems like the market is finally saying, okay, we're just going to reward like the CapEx beneficiaries because they're actually like growing their earnings because companies are buying more steel and copper and other things like that to build out these data centers. But the actual AI software, how that's rippling through margins, that's kind of still the piece that needs to be rewarded, I guess. And
it's still early too, which is, I think still people forget, like it's been maybe
Oh yeah.
3 years
Yeah.
now, but
Yeah.
like we're still pretty early for the potential, and we're already kind of seeing good, interesting products or use cases come out with all this stuff too,
Oh, for
right?
sure.
So
For sure.
outside of the hyperscalers, the AI trade remains full speed ahead. Capital equipment companies, pretty much across the board, have posted strong results with good strength in backlogs and their pipelines. Data centers continue to sell out of their supply, and still have access to demand above and beyond their supply. Semiconductor companies seem to have good visibility over the next 12 to 24 months, and again, not really seeing any concerns on the demand side of things on that side either. So on the US side, it's, I mean, markets haven't been quiet, but earnings actually have been, from what I've been looking at, have been a pretty inline type of earnings, not a whole lot in the way of surprises there.
Yeah. Yeah.
On the Canadian side, as I mentioned, we're getting a bit into Canadian earnings now too. So Agnico Eagle is a major kind of gold miner. They reported a largely inline quarter, which maybe doesn't sound that impressive, but when you look at what they've done year over year, earnings are 96% higher than they were in the prior year, and revenues are up 43%. Obviously, a lot of this is due to the very significant run in gold over the last year. But still very impressive results regardless. They've had pretty much a transformational year over the last year with the help of higher gold prices. Their balance sheet is much stronger now. Not that it was really a concern before, but they've pretty much eliminated most of their debt at this point. They returned a third of their cash flow to shareholders through buybacks and dividends. And it's not official yet, but they're working on renewing their $2 billion share repurchase program as well. So again, kind of a good result, but inline result from AEM there. Enbridge also had a good quarter. Revenues were largely in line, but they had a pretty nice beat on earnings. Earnings came in about 88 cents for that quarter. I think the key point on Enbridge is they have about 14 billion in secured growth capital. So I think it's just a nice thing. They have a really solid, steady line of sight into growth over the next couple of years, probably the foreseeable future. At 23 times earnings, it is a high to mid single digit earnings grower. So, I wouldn't necessarily call it particularly expensive. It's not cheap either, but you kind of get a premium for that stability that it's offering. And I mean, honestly, with that software trade that's going on right now, people pay anything, I think, just to avoid software, it seems. So,
basically.
and that 5% yield offers a bit of stability and certainty as well. The final one we'll talk about is TFI International. TFII is the ticker there. They've reported results that were okay on the quarter. The quarterly results were, like, for the current quarter they reported were good. They had a big beat on earnings, which is nice to see, and revenues were essentially in line. And because they've had about a year and a half string of revenue misses versus expectations, so it's been kind of a tough slog. And it's just they're in a really weak freight environment right now, so you're seeing this across the board for transportation companies, really. So it's not necessarily just a problem at TFII, but so regardless, it was nice to see some stronger results. Markets, I think, wanted a bit of a better first quarter outlook from the company, but I mean, I think they're probably just being. It makes sense for them just to be conservative regardless heading into the new year. I think the key with TFII here is just that it was like the word of the day for them was probably just like bottoming. It feels like the freight environment's maybe bottoming out a bit, and things should improve. Might not be in Q1 or Q2, but heading into the end of this coming year, things should start looking a lot better for this company and the space, the sector in general. So that's largely the kind of specific earnings that I noted here, but it didn't really matter because it was really all about software this month. And so anything, even if you had a good result or a bad result, if you touch software or were adjacent to software, your company probably did not do too well. There's been rolling corrections through the market at every week or every day. It seemed like somebody had developed a new AI tool, and if it was in your vertical where you owned a company, your company was down 10%. In a best case scenario kind of thing. So it is what it is, but it feels like we're kind of getting to the end of these rolling corrections in the software space. Kind of talking about I think there's a bit of a bottoming going out. Some names starting to bounce now, or at least flatten out. Whereas for a
Mhm.
good 2 weeks, a lot of these names just, they had
Oh yeah.
5% down days, day after day after day. It felt like so.
Yeah, for sure.
Um, I think I feel like every time we come on here, we say everyone's talking about the software things. We don't need to talk about too much, so I'm gonna kind of say that again. But I think there's a few key like logical issues that aren't jiving that well with the SaaS and the software argument of how AI is going to take over software and totally replace it or whatever. So I think the first issue is that if it's so easy for startups to create competing products, in theory, it's just as easy for incumbents to like current operating companies to do it at low cost as well. And they have the budget to pay thousands of people to create thousands of new software products as well, right? So,
Mm.
yes, there's increased competition, but if the barriers to entry are so low, the current companies can also go and create these new products that they can cross sell, upsell to their already established customer base, right? So I think those two things kind of don't align that well. Where it's not necessarily just a one-sided issue of now everyone in their basement's going to create a product that's going to take market share. Well, the current operating companies can also create products as well, and they in theory probably know their customers better than the up and comer does.
Mhm.
So
Yeah.
I think that's one kind of thing to keep in mind. The second is I think the incumbents can just buy the competitors. So if you or me are creating I don't even know, some software competing product or whatever, it takes us 5 hours to build it, as people are claiming is what's happening, right? So if
Yeah.
I can do it in 5 hours, my bar of selling that company is probably pretty low, right? So these companies that are already established have lots of revenues. If they actually find some new product that is taking market share from them, they can probably just go buy that company.
Yeah.
And probably in most cases, most people, most companies, whatever you want to call them, are going to sell at I mean, the buying company certainly might overpay, but it's still probably going to be a pretty low price that someone's going to be willing to sell that thing at, right?
Right. Right.
Um, and then I think my final point is, have you ever had a scenario where you're scrolling through Netflix and you scroll and you scroll some more and 30 minutes go by, you still haven't really been able to decide on what you want to choose. So you just turn the TV off and go to bed.
Mhm.
I
Yeah.
think that
Yeah.
could also be an issue with the kind of increased competition from software. It's a bit of the paradox of choice, right? If it's going to be the case that everyone and their grandmother can create a competing software product, there's going to be so many things to choose from. It's going to be so hard for any single product or company to rise to the top. So what are you going to do? You're going to go default on the currently established companies that already have the scale, already have the moat, already have the advertising capabilities to get
Mhm.
your attention, whatever it is, right? I think that's one other thing
Yeah.
that gets missed. Where if you have so many competing products coming in, they start kind of crashing into each other and canceling each other out because it's such a noisy environment.
Yeah. No, for sure. That's a really interesting final point there too, because yeah, I'm thinking about it now, and it makes a lot of sense. Like, if we are truly just commoditizing, if like somehow people are just commoditizing these new software products by using AI, then there's no real network effect to each one of them. Like, you really need good network effect to attach to one single, software platform that has good staying power and stickiness. And if you have just, huge saturation of like 50 new software companies and software platforms out there because of AI, I mean, it's going to be hard for all of them to get some sort of network effect. And it's going to be like a funnel just into at least a handful of those platforms. And that could be one of the incumbents that, uses AI to leverage up their existing platforms. So
Yeah.
I think that makes a lot of sense. Yeah.
Well, yeah, and with like, don't get me wrong, I'm not. I don't think investors should ignore the risks that AI can pose to software and various business. Certainly, like there are real risks there. I just think that a lot of it is getting extrapolated to a very large degree.
Mhm.
But I do think if you're going to focus on an area that might be impacted, I think it's kind of the direct to consumer type of software products. I think those might be
Yeah.
your most at risk areas.
Yeah. Yeah, no, for sure. Yeah, no, those are all good takes. And yeah, it's really true. And I think, yeah, using logic and just kind of seeing through the market and looking at, is this software sell-off, is this logical across all domains of software, or is it, really just going to apply to a handful of different industries within software? Um, Time will tell, but certainly, this sort of sell-off has all the makings of like just a waterfall type decline where it's like this capitulation, and there will be some winners that will emerge, and we might see some names that just kind of flatline for a while, but it'll be interesting to see. But yeah, certainly I think, it's definitely like a sell first, and then just kind of figure out what to do after that. So
Yeah, for sure.
yeah. Nice. Okay, that's a solid roundup of the market pulse. So yeah, next moving into tweet of the week, hot takes on the market. So I just have one tweet here that I want to pull up. So this is from Bespoke on Twitter/X, and they say, crazy market stat: the S&P 500 is flat year to date, but there are just 94 stocks in the index that are up or down less than 5% year to date, while there are about 117 stocks up or down more than 20% year to date. And they put out a graph of kind of what that looks like. So basically we can see, the S&P 500 in that red text is, just about flat year to date. The dark blue area, that's, 94 stocks out of the 500 that are up or down less than 5%. And then on the opposite sides of the spectrum in the orange area, that's, 117 stocks that are up 20% or more or down 20% or more year to date. So this really kind of speaks to this like hugely bifurcated market that we have this year. And what I've been thinking about a lot is how the VIX is so high. Like the VIX is, it was in the high like 15 to 20 range, and now it's just hovering around 20. And yet the market's holding up. We can see the market as a whole is actually like, kind of flat. Most days it's up just 0.5% or down less than 0.5%. And yet we see this massive divergence across individual stocks where some are up or down 20%. And so that's kind of the overarching like theme of this year, I think, is just this this massively bifurcated market. So I thought that was really interesting.
We started talking about this a bit earlier too, right? Where this market feels a bit like, not the first time, but it's been a while since diversification has really actually kind of helped the portfolio a whole lot, at least within the equity space. In the past couple of years, everything sort of felt like a one-way trade. If everything's just down or up to varying degrees, whereas this market's felt more like, if you only had a software portfolio, you're probably not too happy, but a lot of other things have done well to help offset the volatility in that space as well. So it's nice, it's welcome, because that's how markets should function in my view. But interesting.
No, for sure. It's definitely a different year than we've had in the last few. So,
and we're only a month and a half in.
Yeah, that's
like
right.
A full year already
so far. Yeah. All right. And then next, do you want to go through Dividend Radar?
Sure, we can do that one quickly. Gold companies are coming in with the big dividend increases this quarter so far. Again, we're pretty early in earnings season here for Canada, but Barrick Mining increased their dividend by 140%. Alamos Gold had a 60% dividend increase. Franco-Nevada had a 15% increase, and kind of the other notable one that's not a gold company, obviously, it was Brookfield Corp. They had a 17% increase to their dividend.
Okay, nice. Some good low dividend increases. All right. And then we have our four noteworthy questions from our Q&A service that we're going to go through. So I'm going to share my screen and just go over my first question that I've highlighted here. So this comes from Eves on the Q&A. So they mentioned, just a comment, I'm sure I'm not alone in this situation. All of these names are down 30 to 45% in my TFSA. I hate it when it feels like everybody is wrong and you and a few others think you are right. Or are we? It feels like Armageddon. Been there before. It's not fun, but they now only represent 5% of my portfolio, so I'll survive. but my TFSA will take a huge hit this year. We kind of mentioned, it's been a tough year for many growth stocks, but conditions can and do change, sometimes quickly. When everyone hates everything, bottoms can be formed. Certainly right now, fear and not fundamentals are driving the bus. And so, there's a few things to talk about here, but like one is that point about when everyone hates everything. So basically, if software is really hated, it's really sold off. There's a potential that means that most people have sold software. And when you have like no marginal seller, that's usually when sell pressure stops. And even if there's no buy pressure, it's not as big of a factor, because all of a sudden, all you need is the selling to stop. And that's how, stocks can go sideways and eventually recover and bottom. And then on the second point is that, conditions can and do change sometimes quickly. And so, there's a lot of stocks that are down pretty massively year to date. But, we've seen this rotation happen between, some of these high growth stocks and defensive stocks over the past few years. And so I wanted to highlight this chart that I built that I felt represented kind of this ebb and flow of the market and this like cyclicality of it, especially over the last, few years. So this is starting in basically early 2023. So this is kind of like since the beginning of this like big bull run that we've had in tech stocks and in the broader markets in general. And what it's looking at is the top panel is the ARK ETF divided by the XLP ETF, which is consumer staples. So it's essentially like a proxy for how much outperformance has, high beta stocks, kind of more like, out the risk curve type stocks seen relative to your traditional defensive and staples kind of area. So this is on the weekly chart. And so the top is the weekly ratio. And then in the bottom is the RSI. And so I really, it's pretty much impossible to like time the tops and bottoms, especially using the RSI, things like that. But because the RSI is this like flat, momentum oscillator, it kind of helps to see, when things get a little bit overheated and when things have gone a little bit too far to the oversold region. And then I highlighted kind of where those spots were in terms of the oversold region over the past few years. And I thought it was interesting because each one represented this substantial kind of significant area where there was so much happening in the macro, in the news, sentiment wise, everything like that. And you would see like all of these, high growth tech stocks and other stocks like that were selling off massively in those periods. So the first one is, this first period is late 2022, early 2023. We had, kind of inflation, peak interest rates, like the higher for longer sort of narrative. So that kind of took stocks down. And that was the end of, 2022 bear market. So things just kind of flushed into the bottom there. And then late 2023 is the next period. This is basically that time when all economists were calling for a recession in 2024. And so it was almost like 100% guaranteed that we were going to get this recession. That was at least the narrative. And stocks sold off into that. And it was also kind of the lingering effects of the regional banking crisis in the US. So all of those factors kind of led to that massive sell-off. And then in the summer of 2024, that's when we had the yen carry trade unwind. A lot of stocks got hit hard there. And then we had April 2025, that's Liberation Day. And now again, we're seeing that RSI drop. And this is kind of this AI kills software sort of narrative. And, it's not just software that's going down, it's other stocks. And so it's really this like broader based investor sentiment. So I thought this was really interesting. And this kind of points to like, things can change quickly, and they often do. And so if someone has, stocks that are down like 35 to 50% this year, it's kind of par for the course for what we've seen over the past like few years at least.
And it's also kind of a defensive versus growth type of rotation too. It looks like, right?
Yeah, exactly. Yeah. So I thought that was kind of interesting. And then secondly, okay, so I got my second question here. Yeah, so I won't dig too much into this, but I'd be remiss if I didn't talk about Halo stocks today. So the question is, thank you for your just published special report on AI, but will you soon publish a report listing the companies and sectors which will be negatively affected and whose moat will be disrupted? So we do have this, special report on our website for the AI compute stack and different companies that are involved. So we kind of mentioned that basically, I won't go through it all, but the most Halo, which is heavy assets, low obsolescence. These are like companies that have physical assets. The general theme is if you can type something into a prompt through an LLM and it disrupts a company, that's not Halo. Halo is something that is very unlikely to be disrupted by a chatbot or an LLM. So, like Caterpillar, things like that, like heavy machinery, you can't really disrupt with AI as much. So from that report, we have physical infrastructure in the power layer, semiconductor, hardware, and connectivity layer. And then kind of these names like, Chemco, CCO, BWXT, VST, Vistra, Energy, Talon, Vertiv, Fix, NVIDIA. A lot of these are like industrials and physical. They deal with like the physical parts and it's not software based. So that's most Halo. Then least Halo, the most at risk of disruption is number 4 from that report, which is application and AI enabled services layer. So specifically, we're looking at data management, AI enabled services, media, consumer AI. So names like Snow, Datadog, AppLovin, Pegasystems, JFrog, Roblox, things like that. Now, there is some nuance here. So not all of those will be just uniformly disrupted. But when we look at more of that software layer, individual companies that may be able to benefit from AI if they can integrate it, the other side of that is that they're also at risk of being disrupted by AI if they don't adapt or they're not quick enough to adapt. So that's kind of the most Halo to least Halo kind of ranking.
I was surprised that I thought healthcare would be a bit more at the forefront in this type of rotation.
Yeah.
It just seems like everyone's trying to avoid,
Right.
call it software in general, or whether not even just or like almost technology by extension to a degree.
Yeah.
So I thought that was kind of interesting. I think healthcare's done okay, but I just thought they would maybe this would be kind of its breakout moment sort of thing with that type of rotation. But
yeah, that is interesting. Like industrials, consumer staples, energy all benefited, but healthcare and utilities benefited, but healthcare did not. And it has a lot of physical infrastructure. So yeah, interesting.
Okay, those are good. All right, I'm only going to do one question, one noteworthy question today, but sort of I think dovetails a little bit into what you were talking about earlier, but it's just on sentiment drawdowns. So general questions about how do you deal with poor sentiment and how do you kind of get a gauge of when it's going to stop. I think the hard part is that you just don't, right? It's a narrative. It's sentiment driven. It can be very painful to sit through if you own stocks that are in kind of a sentiment shift and are in a drawdown because of it. And it's painful because it's not fundamentally driven, right? So you're watching the stock, you know things look good on the balance sheet, they're growing, whatever it is, but the stock continues to go down, and really it's going through a re-rating in the valuation is the big issue. And what that number that markets are going to reward it with for evaluation is that it's not that it's anyone's guess, but it's hard to pinpoint what it is. And the stock's probably going to overshoot or undershoot what that valuation truly will be over, call it a longer time frame. So maybe a stock's going from 25 times earnings and its steady state should be something closer to 20 times earnings. In that type of nasty market shift, it's probably going to overshoot to 15 times earnings or something like that. And then over time grind back to where it should be with say at that 20x level. So overall, I mean, sentiment drawdowns are tough because it's very like nebulous in terms of how far and how long the stocks are gonna decline. I think the one other side of this though is that it does work both ways, right? So you have these kind of downwards re-ratings, but also on the upside, this is when stocks can work out really well, right? You have fundamentals working the right way, so you're getting companies growing at a fundamental basis, and then markets have caught on to it and they re-rate that company higher. I mean, that's happening with industrials, honestly, right? There's cyclical companies that historically have traded mid-teens type of valuations, and a lot of them are now 30 times plus forward earnings, right? So that'll be a problem in a future period, probably not this year, but at some point that'll be the kind of the other straw, I guess, to that'll cause issues. But the point being, it does work both ways. But the gist of the question here is like, how do you kind of combat this? How do you deal with these sentiment shifts? So one is just diversification. We started talking about this earlier. Being diversified across styles, across sectors can go a long way to making sure that your portfolio is not totally over concentrated in a single type of theme, factor, sector, whatever it is. And if you were diversified, I mean, you probably had a couple lumps this year to date period, but it probably didn't hurt a whole lot because you have other things that have done well also. Rebalancing as well. Software has done well over the last 5 to 10 years. If you've been rebalancing over that time, even if it's not an aggressive way, you've just been rebalancing. Again, this drawdown probably doesn't hurt a whole lot because you've been managing that position sizing as well. And when a company is at a reasonable starting weighting, when it goes into that drawdown, it quickly kind of takes care of itself from a weighting problem, right? So say if you go from a 5% position to a 2.5% position, now at that 2.5% of your total portfolio, if it goes up or down, it's probably not hurting a whole lot anymore at this point. Obviously, ideally, you wouldn't go from 5 to 2.5, but again, it's sort of you've had the major drawdown now, and it's less of an issue in the total portfolio. However, if you're starting at a 10% position and that goes down to 5%, that's a hefty initial hit, and then you're still at kind of a largish position at 5%. If it continues to go down from there, right? So it just takes a lot longer for the weighting to call it deal with itself naturally in a drawdown. So just keeping weightings and rebalancing in check helps. Also try to avoid catching a falling knife. I've been finding this more and more in kind of call it post-COVID type of markets. Is just things just go down longer and deeper than they should, and you expect them to. And lo and behold, then after a good earnings report, whatever it is, they'll jump 20% back to a reasonable level. But every time you think it's time to buy a stock that's in a drawdown, I almost would say sit on your hands for another week and just to get some confidence that that drawdown has sort of worked its way through. And honestly, in a lot of cases, I'd probably prefer buying a company at 10% of a higher, like up 10% from a certain level, than continually adding to a losing name that continues to kind of bleed lower, because that can be a recipe for disaster over time. So that's one way to kind of call it manage the risk on when you have these sentiment shifts. On when to buy, I think you kind of have to start sharpening your pencil on certain companies and say, okay, it's a bad market. Fundamentally, this company's fine. If it gets to a certain valuation, then I'm just going to have to kind of plug my nose and buy it. I may not be timing it perfectly, but I can be confident over a 1 to 3 year period that it's going to do fine over that period. Obviously, it's what that valuation is harder to say. And I think just the tweak to that is that doesn't mean, back up. I don't think this way in stocks in general, but it's not a back up the truck when it hits that valuation level. It's a start picking away at it, right? Start adding to it. It's probably going to get cheaper from what you think is that perfect buy level. It's probably going to even go lower than that if it actually hits that level to begin with. So just pick away a bit more. And then you'll kind of slowly but surely kind of have that full position. And even if it doesn't work out in that first, month, quarter, whatever it is, you're probably pretty comfortable with it because you know that the odds are stacked in your favor in terms of your entry point. And then when it starts to have better momentum and turn and kind of get to see a bit of a bounce and some positive momentum, then you can kind of build it into a full position at that point.
No, those are really good points. And Yeah. I mean, certainly one thing that I found is usually when you're feeling like pretty sick to your stomach about buying a stock, it's usually it can be usually be a good long term decision sometimes. So it works out long term. So um, and usually when we see things like absolutely, collapse and just go down, in a straight line. Usually excitement's pretty high across both, bulls and bears, and it's just kind of like a recent event. So we saw this with software stocks over like I think 2 to 3 weeks ago, where things were going down like 10 to 15% a day, and that can like cause a lot of excitement with people where it's you might buy too soon because you think that's definitely the bottom, or you might you know decide to take the other side. But really, I found that, yeah, once you wait for the dust to settle, things to kind of go flatline, and then people get really bearish on it just because it isn't doing anything. But you're still feeling pretty uneasy about buying because it's down so much and it's underperforming. That's usually kind of a decent window, I find, when things are a little bit more opportunistic to buy. So cool. Yeah, I like that. Yeah. So then going through highlighting a recent 5i report. So this one is Magellan Aerospace. MAL is the ticker. So, MAL is a diversified aerospace and defense company that designs, manufactures, and supports complex components and systems for commercial aircraft, military platforms, space applications, and aftermarket services. It operates across a wide array of aerospace segments with a global customer base, and it has a strong and growing backlog, improving margins, and resilient long-term demand in both commercial aviation and defense. And so, kind of a major catalyst of why I'm bringing this one up is, especially and why its recent momentum has been so good is, Mark Carney's shift toward domestic spending for defense initiatives. So a lot of that, increased spending for domestic sort of, defense contracts and other things like that is really propping up a lot of these Canadian defense names. And Magellan's been benefiting from that. And then also on the commercial side, it's seeing an ongoing recovery in airline traffic and aircraft production. So yeah, overall the thesis is kind of that it has solid business momentum, fundamentals are doing well, it has a solid industry backdrop, and it also recently resumed buybacks. So yeah, this is one that I think investors can kind of put on their watch list.
Yeah, I like the theme as well. And there's not in Canada, there's not too many, call it pure play aerospace type of companies out there as well. There's maybe, I don't know, 4 top of my head that I can think of. So when the demand comes into that space, it can come in aggressively for certain names. So
yeah,
I like the theme. I like the spending initiatives at the government side. I think kind of unrelated, but I still want to know where our data centers are in Canada. Like I feel like it's just like a easy win. We have the space. Just throw up, like it's easy. Like 10 data centers. Each province gets a couple. I don't know, right? But like it just seems like that'd be a huge boost to the economy, and there's probably the demand for that type of capacity, right?
For sure, yeah.
And maybe it is happening. I'm just not seeing it. But I just don't see a whole lot about data centers in Canada when it feels like we'd be pretty ripe for
that's right,
for that type of infrastructure build out. But
we've got the climate, and
space.
We got the space, Everything lines up, That's fair. Okay, awesome. And then I'll just go through this last section here. So this is on Investor Edge, quick lessons from the field, a little bit of investor education. So I'm just going to pull up this slide. So essentially, this is something that I found kind of interesting that I've noticed across, investors and things like that. But when screening and looking for new stocks to buy, I think a lot of investors start and sometimes even stop with fundamentals. So they'll screen for strong businesses, good balance sheets, strong revenue growth, expanding margins, attractive valuations, things like that. And those are all important and really good qualities to screen for. But fundamentals are just one piece of the equation when it comes to, the markets. So they kind of help you to tell you what you own. But there's also this other layer that I think often gets overlooked, and it's price performance. So, performance isn't really just about chasing hype, but it's more about listening to what the market is saying. Investors can find a company that looks good on paper, it's got solid growth, healthy margins, but yet the stock might not go anywhere, or it could just trend lower. This is when it's worth asking why. So maybe the theme isn't working at that time, or the expectations are already priced in, or maybe there's a risk that the market is pricing in that one is not aware of. But on the flip side, when a stock is making new highs and has good quality fundamentals, that helps to confirm something. This is, effectively listening to the market, and the market is at that point saying that the fundamentals matter, the narrative is working, and capital is flowing to that space. And usually investors are willing to pay higher prices for that business. So, essentially combining strong fundamentals and positive price momentum really helps to own a good company that's actively connected to the market's current themes, trends, and capital flows. So it's really like, weaving in, a solid company on paper that has the right fundamentals, but then also weaving it into the actual current market fabric to make sure that, is the market rewarding that stock? Is it moving higher? Things like that. And that's not to say that investors need to always buy, momentum stocks or stocks that are working. But, if one is looking for a stock that is working, or at least has worked over a long term, connecting the fundamentals with momentum is really powerful. And that kind of goes back to Magellan, which we just talked about. Like, it's one of those stocks where, for a little while it wasn't doing too much. And then all of a sudden, the narrative comes in, the fundamentals are already there. Then the fundamentals have some sort of like industry backdrop, and then everything just kind of all works at once. And if someone can identify that early enough, then they can, own something that has long-term staying power.
Yeah. Yeah. And I think you don't even necessarily have to be early either for them to work, right? I mean, if something's working and the fundamentals are going to grow over a long time and the market's catching on to it, I mean, everyone's seen it, but stocks can go up for years with strong momentum kind of thing. So it's
for sure.
Because I think a lot of people kind of look at that and say, oh, well, it's up 10% now, and it's like, I missed my chance or whatever. And that's oftentimes, if it's a real, then you go back to the fundamentals. The fundamentals are real. They're actually growing. The market opportunity, whatever it is there. Mm-hmm. They can do quite well. So
yeah. And case in point, like the gold stocks, right? Like they've just kind of kept going up as the price of gold goes up, and they're almost pricing in like lower gold prices. So it's like almost a lagging benefit, really. So yeah, it's crazy. But so that is that. I think, what are we at here? 42 minutes. That's pretty good.
Perfect.
Solid. Okay. Well, that's all for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website and sign up for a free trial if you haven't already at 5iresearch.ca/trial. If you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and see you next time.